You are listening to The Vocal Technologist. Spoken tech for your ears.
By the end of this month, the fastest growing consumer demographic on the planet won't actually have a heartbeat.
Right.
They won't sleep. They won't suffer from, decision fatigue.
Yeah.
And they are about to start spending your money.
It's happening fast.
Yeah, it really is. Welcome to today's deep dive. It is Friday, June 5, 2026. And for you listening right now, we have a really fascinating journey ahead of us.
We definitely do.
We've got a fresh stack of TLDR FinTech newsletters from earlier this week. And our mission today is to kind of connect the dots on this massive structural shift that's happening right beneath the surface of the global economy.
Yeah, it is a massive shift.
By the time we are done here, you'll understand why the biggest financial battle of the decade involves AI agents just, buying things autonomously, physical computer chips being treated like prime commercial real estate, and a looming, really high-stakes war over stablecoins.
Yeah, all colliding at once.
Exactly. Okay, let's unpack this. We have to start with the sheer unprecedented scale of the AI infrastructure boom.
The numbers we are seeing this week, they force a total rethinking of capital allocation in the tech sector.
Right.
The era of running, lean software startups in a garage that's being replaced by heavy industrial infrastructure projects.
The scale is what caught my eye immediately. Let's look at Anthropic. According to our sources, Anthropic has confidentially filed for an IPO, which positions them to potentially beat OpenAI to the public markets.
Which is a huge deal.
Massive. And the valuation attached to this filing is $965 billion.
Just shy of $1 trillion.
Right. We are talking about a company knocking on the door of $1 trillion market cap, fueled by an annualized revenue run rate that's expected to exceed $50 billion by the end of this month.
To contextualize that velocity, traditional enterprise software giants took decades of grueling sales cycles to reach a $50 billion run rate.
Decades, yeah.
And Anthropic is achieving this in just a fraction of the time. The massive enterprise adoption of their Claude AI for complex coding, cybersecurity, and deep knowledge work, it signals that frontier AI has completely exited the venture capital experimentation phase.
It's graduated.
Exactly. It is now foundational enterprise infrastructure.
But building that foundation requires raw computing power, right? Which brings us to the hardware.
The chips.
Right. Apollo and Blackstone are assembling a private credit deal specifically to finance Google TPU's tensor processing units for Anthropic.
Yeah.
And the size of this financing vehicle is $36 billion. Wait, so they aren't just taking out a loan, they're using a special purpose vehicle to lease computer chips.
Yes.
Normally we see special purpose vehicles, or SPVs, used to isolate financial risk for huge physical assets. An airline uses an SPV to lease a fleet of Boeing 777s without putting billions in debt on their own balance sheet.
That airline analogy is actually the perfect lens for this. What's fascinating here is leveraged finance used to be dominated by funding corporate mergers or building offshore wind farms. Now, the capital is flowing directly into data centers, power grids, and chips.
Just raw compute.
Exactly. And it is crucial to understand why they are financing PPUs specifically. Standard computer processors, like CPUs, handle tasks sequentially. They are generalists.
Okay.
Even GPUs, which, started in video games, they process graphics in parallel. But tensor processing units are custom designed and hardwired specifically for the massive matrix multiplication that neural networks require.
So they're purpose-built.
They are highly specialized industrial looms for AI. Private credit firms are treating these processors as a utility class, no different than a toll road or a natural gas pipeline, because the demand is practically guaranteed.
Guaranteed and accelerating, right?
Yeah.
Our sources highlight a Goldman Sachs projection that AI token consumption is forecast to increase 24-fold by 2030.
A 24-fold increase fundamentally alters the unit economics of the entire tech industry. Well, Goldman's analysis points out a crucial mechanism, the flywheel of falling compute costs. Initially, there was widespread market fear that these tech giants would just incinerate cash forever building these data centers.
Right, just burning billions.
Right. But as the cost of processing a single AI token drops, it massively expands the profit margins for the software layer built on top of it.
Oh, I see.
Cheaper compute leads to exponentially more usage, which generates heavier cash flow, which in turn, services the debt on that $36 billion SPV.
But pouring $36 billion into specialized chips begs the question, What are they building that requires this much juice?
It's not just chat.
Right. It certainly isn't just a faster chatbot to help us draft polite emails. We are moving from AI that talks to AI that acts. This computing power is being deployed to power agents, autonomous software that will actually do our work and, crucially, spend our money.
The transition from generative AI to agentic AI is the bridge between a neat parlor trick and an entirely new economic engine.
That's a good way to put it.
If we connect this to the bigger picture, generative AI gives you a recipe. Agentic AI buys the groceries, preheats the oven, and cooks the meal without you having to intervene at all.
The real-world application of this is already staggering. Let's look at the data from TD Bank.
Yeah, this was wild.
They are currently using Agentic AI to drop their mortgage pre-adjudication times from 15 hours down to 3 minutes.
Unbelievable.
And they are projecting $500 million in annual cost savings from this, alongside another $500 million in revenue uplift. But how does that actually work mechanically? I mean, you can't just throw an unstructured PDF of a W-2 at a language model and hand out a $500,000 loan.
No, you don't. The magic of agentic workflows lies in parallel processing.
Okay.
Instead of one human loan officer sequentially checking boxes, the system spins up multiple specialized subagents.
A whole team of them.
Exactly. One agent specifically ingests and authenticates the tax documents. Simultaneously, a second agent cross-references the applicant's credit history against a live compliance database.
While a third is doing something else.
A third agent runs predictive fraud modeling. They execute all these distinct, highly regulated tasks in parallel, synthesize the findings, and deliver a mathematically sound adjudication in 180 seconds.
Wow.
It is basically doing the work of an entire back-office floor simultaneously.
Which perfectly explains the news about Ceres. They just raised a $28.8 million Series A, led by 8VC, specifically to automate manual back-office work for banks.
Right.
They claim they can automate up to 70% of lending tasks. The institutional side of this makes total sense.
Right.
But where this gets wild, and frankly where it gets into everyday consumer territory, is the retail side.
Oh yeah, commerce.
Visa and Mastercard are actively laying the groundwork for what they call agentic commerce. Visa just invested in Replit, a developer platform known for something called vibe coding.
Vibe code, yeah.
Unpack vibe coding for the listener, because, I mean, it sounds like something a teenager does on TikTok, not a foundational layer of global finance.
The term is definitely colloquial, but the mechanics are revolutionary. Historically, to build software that interacts with a payment gateway, you needed a team of engineers writing rigid syntax in Python or C++ SANIT.
Right.
With vibe coding, a developer or even a non-technical user simply describes the desired behavior or outcome in plain English. You describe the vibe of what you want the program to do.
So you're telling me my AI is going to have its own wallet, negotiate with other AIs, and go shopping for me? That sounds like a sci-fi movie where the robots unionize.
Well, it does sound sci-fi, but here is the economic reality. You type, build me a bot that monitors airline prices to Tokyo and books a direct flight if it drops below $800. The AI understands the intent, writes the code, connects to the necessary APIs, and deploys the agent.
Just from plain text.
Exactly. And Visa's investment in Replit is about ensuring that when anyone spins up one of these agents, it has a secure, embedded way to actually execute the payment. The card networks see AI agents as a massive transaction multiplier. An AI agent doesn't suffer from decision fatigue. It can optimize purchases across dozens of merchants instantly, creating exponentially more transactions than a human shopper ever would.
Let's pause there, because I'm not fully buying that this will be a completely smooth transition. I understand the utopian vision, right? My AI agent instantly scans 1,000 suppliers globally, realizes that buying pens from vendor A, paper from vendor B, and ink from vendor C saves me $4, and executes 15 separate microtransactions to optimize the purchase.
Right, highly optimized.
For Visa, they just turned one transaction into 15, multiplying their swipe fees. But a relentless optimizer sounds great until it, hallucinates.
Oh, sure.
If my vibe-coded AI agent goes rogue and accidentally orders 10,000 industrial staplers because it misread a decimal point, who handles that chargeback? Are Visa and Mastercard seriously prepared for non-human dispute resolution?
That is the multi-billion-dollar vulnerability right there. And it is exactly why Visa is developing what they call the Trusted Agent Protocol.
What does that do?
The card networks know that traditional fraud detection models are built to analyze human behavior typing speed, mouse movements, geographic location.
An AI doesn't have a location.
Exactly. An AI agent doesn't have a geographic location. The Trusted Agent Protocol is about establishing cryptographic boundaries. It essentially creates a specialized, highly restricted virtual card for the agent, hard-coded with absolute spending limits and merchant category restrictions.
If it's contained.
Right. The agent can optimize all at once, but it physically cannot authorize a purchase outside the parameters set by the human.
That structural control is necessary, but it highlights a massive logistical hurdle. If my AI agent is working, vibe coding, and negotiating with other agents 24 hours a day, 7 days a week, globally, it is fundamentally incompatible with the legacy banking system.
It breaks the system.
Right. An autonomous agent in Singapore can't optimize a supply chain purchase at 2 a.m. on a Sunday and then wait for a New York bank to open on Monday at 9 a.m. to clear the payment. A 247 autonomous economy cannot function on a 9-to-5 financial rail.
No, it can't. The friction of legacy clearinghouses becomes an existential bottleneck. Autonomous agents require programmable, instantly settling money.
Which brings us directly to stablecoins. We are watching stablecoins graduate from the speculative fringes of crypto and embed themselves into the core plumbing of traditional finance.
Yes, the mainstreaming.
The Stack notes that SoFi just launched SoFiUSD to its 14.7 million members. This makes them the first U.S. national bank to issue a stablecoin on a public blockchain, pushing it across a platform that supports 160 million accounts.
Massive distribution.
And Mastercard is rolling out support for stablecoin settlement, meaning intraday, weekend, and holiday transactions can actually clear instantly. Even Deal, the massive HR platform, just launched a stablecoin wallet for global contractors so they can get paid instantly, anywhere in the world.
The corporate adoption is moving at breakneck speed, but it is colliding with a regulatory wall.
It really is. The sources outline a very public, very intense clash playing out right now between the traditional banking establishment and the crypto sector. JPMorgan CEO Jamie Dimon has been publicly exchanging blows with Coinbase CEO Brian Armstrong over the Clarity Act.
Yeah, that got heated.
And to be clear, we aren't taking sides here, just reporting what's happening. The Clarity Act is a legislative push designed to clearly define whether digital assets function as securities or commodities, and it attempts to lay down strict rules on how stablecoin reserves must be managed.
Right.
The core issue triggering this fight is yield. Should stablecoin issuers be allowed to pay interest on the money you hold with them?
This raises an important question because the concept of yield is the tripwire for the entire banking industry.
Why is that the line in the sand?
If a tech company issues a stablecoin and pays you 4% interest to hold it to the average consumer, that looks and functions exactly like a traditional bank savings account.
Sure, it feels the same.
But traditional banks point out that the stablecoin issuer is not burdened by the massive capital reserve requirements, the FDIC insurance premiums, or the rigorous stress tests that a JPMorgan has to endure by law.
Ah, I see.
So traditional banks view yield-bearing stablecoins as a form of regulatory arbitrage tech companies playing bank without following the rules of banking.
And what's the other side?
Digital asset firms argue the exact opposite, that legacy rules shouldn't be copy-pasted onto programmable money because it stifles innovation.
We're seeing different philosophies of money colliding. Simon Taylor from FinTech Brain Food wrote an excellent analysis on this that was highlighted in our materials. He frames the debate by separating money into two distinct categories, money that rests and money that moves. Break down the mechanics of that distinction for us.
It is a brilliant way to cut through the regulatory noise. Money that rests is the foundation of traditional banking. You deposit your paycheck, the money sits on the bank's digital ledger, and the bank uses that resting capital to issue mortgages and business loans. That resting money requires heavy regulation because the bank is actively lending it out. Stablecoins, however, represent money that moves. They are designed for pure velocity.
Velocity meaning?
Bypassing slow correspondent banking networks, enabling off-hour settlement for those AI agents we talked about, and serving as a global medium of exchange. Taylor's thesis is that traditional banks are wasting energy trying to kill stablecoins out of fear of losing deposits.
So what should they be doing?
Their actual goal should be to build the toll roads. The future economy requires tokenized bank deposits for money that rests safely and stablecoins for money that moves instantly. Banks need to monetize the flow, not fight the physics of the highway.
The stablecoin is the highway, the bank deposit is the garage. It is an elegant framework. But while we are paving these multi-billion-dollar highways for AI agents and engineering $36 billion SPVs for silicon chips, we have to look at the human layer of this equation.
Yes, the real-world impact.
The sources paint a picture of a massive, jarring divergence happening in the economy right now. Let's look at the corporate winners first. A new report from Blue Dot and FT Partners reveals that the top 100 private FinTech companies are now worth a combined $1.9 trillion.
That's incredible.
That is almost triple the value of the largest public FinTechs founded over the last 2 decades. Companies are staying private significantly longer. Airwallex just hit a $12 billion valuation, with their annual recurring revenue jumping from $1 billion to $1.5 billion in just 7 months.
Airwallex's growth curve is a testament to how aggressively capital rewards the removal of friction.
What friction did they remove?
They identified that international businesses are quietly bleeding capital specifically. 42% of finance leaders are losing budget to hidden foreign exchange markups and intermediary bank fees without even realizing it.
Just gone.
Exactly. Airwallex built an infrastructure layer to seamlessly plug those global FX leaks. In an economy prioritizing efficiency, solving a complex cross-border math problem translates directly to a $12 billion valuation.
And contrast that smooth private market success with the friction of the public markets. Wise, another giant in global payments, watched its stock drop 10% this week after Belgian prosecutors announced an investigation into potential money laundering offenses tied to $500 million in suspicious transactions.
Ouch.
To me, that highlights exactly why the financial sector is so desperate to automate. Moving money globally is incredibly messy and carries immense compliance risk when you're relying on human oversight to catch bad actors.
Human compliance teams simply cannot scale to monitor millions of microtransactions a second. The WISE investigation reinforces the mandate for banks to deploy AI to automate fraud detection or drown in regulatory penalties.
The drive for efficiency is reshaping consumer tech too.
Yeah.
Apple is rolling out iOS 27 next week, and the Wallet app is getting an incredibly slick feature. You can snap a photo of a complicated dinner receipt, and the OS will automatically parse the items, assign them to the correct people in your contacts, calculate the split tax and tip, and fire off the payment requests.
That's pretty convenient.
It entirely removes the social awkwardness of doing math at the table. And Chime is partnering with Invest America to launch Trump accounts starting July 4th, which are specialized child savings accounts aimed at building financial literacy and long-term wealth habits early. It's a strategic move to lock in customer relationships for the next generation.
It is all about smoothing out the human experience, making dinner math invisible, making savings automatic.
But here's where it gets really interesting, and honestly, where the data in our stack gets deeply unsettling. We have a $1.9 trillion private fintech market, we have AI approving mortgages in 3 minutes, and we have Apple making social payments frictionless. But zooming out to the macroeconomic data, U.S. teenagers are heading into the toughest summer job market in 78 years.
Yeah, that was a shocking stat.
It is the weakest seasonal hiring period since the federal government began tracking the data in 1948. Employers in the entertainment and leisure sectors are planning to hire 70% fewer workers than they did last year. Total teen summer jobs are projected to plummet to just 790,000. It feels like we are engineering a hyper-efficient, highly capitalized financial utopia for algorithms and machines, while the entry-level human economy is stalling out, like the ladder's being kicked out from under it.
That is the defining macroeconomic tension of this decade. The surface-level explanation is that inflation and higher operational costs are squeezing the local small businesses that traditionally hire teenagers for the summer.
Right, the usual suspects.
But the structural truth aligns with what Gartner presented to CFOs at their finance symposium this week. Gartner's directive was blunt. AI is no longer a discretionary pilot budget. It is a fundamental operating model mandate.
Meaning, if you aren't replacing manual processes with automation, you're a bleeding margin.
Exactly. Capital behaves like water. It flows toward the path of least resistance and highest yield. If you are a company like Airwallex using software to eliminate global financial friction, you attract billions. If you are an enterprise using Anthropic's Claude to automate knowledge work, your margins expand. But if you are operating in the entry-level manual labor sector of the economy, you are being crushed by a dual mandate of macroeconomic pressure and technological displacement.
The divergence is real.
The capital is aggressively flowing toward the $36 billion AI chips and the agentic workflows, and it is flowing away from the inefficient, unpredictable human elements of the supply chain.
So what does this all mean for you, our listener? We've connected some massive dots today. We started by looking at how Wall Street is utilizing special-purpose vehicles to pour $36 billion into specialized Google TPUs, treating silicon chips like the new industrial real estate.
Huge shift.
We explored how that immense computing power is birthing agentic AI autonomous software that doesn't just draft emails, but uses vibe-coded logic and Visa's trusted agent protocol to actively negotiate and spend money on our behalf.
We then unpack the logistical reality that 247 AI agents require 247 money, pushing stablecoins out of the crypto fringes and into the center of a fierce regulatory battle over the definition of deposits, yield, and the nature of money that moves.
All of which is culminating in a deeply bifurcated economy. A world where private fintechs are valued at nearly $2 trillion for solving complex digital friction, while the entry-level human workforce faces the steepest drop in opportunity in modern history.
Which leaves us with a paradox that the financial industry isn't quite ready to face. For the last 50 years, every credit card, every loan, and every savings account has been engineered around human psychology.
Right.
We built risk models based on human spending habits, human sleep cycles, and human impulse control. But if the fastest-growing consumer demographic of the next decade isn't human at all, but rather a swarm of autonomous AI agents optimizing stablecoin microtransactions around the clock, what does a bank even look like when its biggest, most profitable customer doesn't have a heartbeat?
That is a phenomenal question to leave off on. The invisible money machine is fully decoupling from the human exchange floor we used to know. Thank you so much for joining us on this deep dive. Keep questioning the world around you, keep looking for the mechanics behind the headlines, and we will catch you next time.
Spoken Tech for your ears.